Today, we are going to be talking about starting a 401k plan in 2025, the ultimate guide. So to begin with, what is a 401k plan and what is it in relationship to other choices, all right? There are 401k plans, there are simple IRAs, and there are SEP IRAs, all right? Now, they are all different types of retirement plans, but how they are very frequently or most often described or delineated is how much money you can put in them, okay? The maximum amount that an employee can defer to a simple is $16,500, and we're talking next year, this is a 2025 video, and if they're born in 1975 or before, they can put in an extra $3,500. That's called catch up. All right. SEPs are the lesser of 25% of net earned income up to $70,000. There is no catch-up concept with a SEP. And then, of course, with 401k, we have 3 limits now, don't we, dear? All right. So you have your basic $23,500 limit. Plus, if you're born in 1975 or before, you get an extra $7,500. And if in 2025 you are 60, 61, 62, or 63 years old, you get an extra $3,750 in your catch-up bucket. This is a good thing for some of us. Anyways, and of course, 401k plans, you get a choice between pre-tax and Roth.
So when you're starting a 401k plan, you do have a choice, bundled or unbundled.
Right.
And what are they? And why is going with the TPA better? Now, bundled is when you have most of the providers are the same one. Like your payroll company is the same as your TPA, is the same as your record keeper, the same as your investment advisor, because there's some that goes all the way across.
Right.
And unbundled is when they're separate entities. And the whole thought is that when it's one long thing and everybody's together, it sounds easy.
Supposedly.
But the parts don't talk to each other, and a lot of times you're just getting the average of their abilities, which is a low average versus...
You are so cruel. Keep going, girl. Keep going.
But I said it so nicely.
Yes, you did. Yes, you did. So one of the things that's different, and we think better, with the unbundled model with your compliance consultant or your TPA, is that things are more transparent, and all the pieces are interchangeable. So each component needs to be, well, they're more accountable. They need to be more responsive to the plan participant, because you can change the record keeper or the TPA or the financial advisor, and you can change those parts out without affecting the other two. Yep. And you can't really do that with a bundled. It's a lot more pain to move the thing, to move the plan. So once we've made those decisions, you need to decide what features you're going to have inside your 401k plan.
How many cup holders?
How many cup holders? So what is the most basic foundation in a 401k plan, Catherine? What is the contribution type that every 401k plan has?
Employee
deferrals, right. The actual 401k contribution. All 401k plans are going to have employee deferrals. All right, because that makes it a 401k plan. Now then, you get to decide as the employer what type of additional employer contributions you're going to put on there, all right? Are you going to make an extra type of employer contribution that means you don't have to pass testing? Are you going to put even additional discretionary contributions in there so that certain employees of the firm get the maximum allowable allocation, all right? Those are all different types of contributions that you put inside your 401k plan. You're going to start with your 401k plan. That's like the floor. You always have to have a floor, but how many walls and doors and windows and things like that you're going to have, that's going to be an additional conversation depending on how many employees you've got, disposable income, cash flow, age demographics, things like that, and a bunch of other factors. Now then, Catherine, are all these plans free or do they have to pay?
Well, you got to pay something.
You got to pay something.
But there is more money provided right at this point in time coming straight up. There's some very good tax credits immediately.
There are 3 different types of tax credits for new plans to start in 2025. One of them is a minimum $500 tax credit. It's $250 times each non-highly compensated employee with a maximum of $5,000. So that covers actual expenses out of pocket for the employer, all right? The second new plan tax credit is the employer contribution credit. This is up to $1,000 for every employee. Notice I didn't say non-highly compensated employee. So this one even goes to highly compensated
a crazy
employees.
Number for me.
Right. So it's $1,000 for everybody making under 100 grand. All right. And well, it's up to $1,000 tax credit. All right. And that's 100% for your first 50 employees. And then number 3, this is what you're talking about before with the automatic enrollment. You don't have to be a new plan. You have to be a small plan, but you don't have to be a new plan. If when you add automatic enrollment to your plan, you get a $500 tax credit for 3 years. Now, what's so funny about this auto enrollment tax credit in 2025?
You can be a solo 401k plan or an owner-only 401k plan and
still get it.
Get it because you are forcing yourself in.
Well, that is true, but also every new plan in 2025 has to have auto enrollment.
And those are new plans, but you're talking about old plans can do it too.
Old plans can do it, but even new plans. So
it's a credit for everyone.
It's a credit. You get a credit. You get a credit. You get a credit. Okay, never mind. All right. What Zach reminded me of is that with what our fees are for most of the new plans we've started, they're actually net positive with the credits. So in other words, we've billed them something for 2024. Their tax credit is going to offset what we've billed them or what they've paid us directly in 2024. But then because they've added automatic enrollment to their plan starting this year, all right, they're going to get an extra $500. So we have a bunch of new clients this year that are going to be $500 ahead of the game for having a 401k plan. Okay, that's not a bad deal. And then when you take into account the tax credits on the employer contribution, they're definitely working on a win-win mindset here. Please go to the website. The tax credit calculator is there. You know what to do with this video. Like, subscribe, comment, whether you're seeing this on LinkedIn or YouTube. Let people know about it. And of course, please don't forget to keep those cards and letters coming.
Toodaloo.